Good morning, everyone. Thank you for your patience. We shall start our webinar. As you can see from this slide itself, that we have plenty of results updates as well as sector and US updates to present this morning. So I'll just start off with Old Chang Kee as well as Ao Sing's site visit note. So Old Chang Kee, as stated here, as the title says it all, that we have a strong finish in fourth quarter. Do recall that their financial year ends in March, so the fourth quarter is end of March this year. So we have a strong finish, and this actually marks the inflection point that we have been advocating since 1 year ago. So just to bring you through the fourth quarter earnings as well as the full year's results. So if you look at these three columns here, which compares on the fourth quarter results, you can see that the top line growth is actually driven by product innovation. We have been seeing such a high growth numbers ever since their new factory has been commissioned. And if you are following this counter, you will be aware that they have just recently commissioned another new factory or revamped their old factory and integrated it by end of third quarter, which is end of last year. So with the fourth quarter, we have been seeing a strong growth continuing, and this actually brought up the revenue, full year revenue growth of 9.1%. This marked the strongest growth in the past 5 years. And if you look down to the gross profit line, yes, for the past 3 quarters in FY18, we have been seeing quite a depressed gross margin of about 61% as compared to the historical 63%. This is mainly due to the high raw material costs and change in product mix. Do note that there are puff products of higher margin, and we have been seeing some promotional strategies that was being implemented by the group in the first 3 quarters. Nonetheless, we take comfort that in the fourth quarter, we are seeing that the gross margin has actually returned back to 63%. And we believe that this should be sustainable throughout FY19. Why is it so? Because the management has actually passed on the higher raw material costs to consumers, and they have actually carried out some of the cost savings initiatives coming from the bulk purchasing. So with that, you can see that it actually trickled down, and the only negative point that we can squeeze out from this set of good results is that there's a startup cost incurred by its UK JV. Do note that this UK JV has yet to open, but is on track for its commission in June this year. Nonetheless, we believe that with only one outlet in UK is unlikely to move the needle for FY19. We remain positive on the Old Chang Kee as we expect the growth momentum to continue into FY19. We believe that it's going to continue to grow its store count let me bring you through here where we have been seeing that there's a trend of net 1 store opening per year in the past few years. So we believe that this trend should continue into FY19. And we believe that with the new factories as well as the new equipment, product innovation should continue, and this should drive and stimulate more demand. And we have been continually emphasize on this new factory that they have commissioned and completely integrated in end of December last year. It has proven that as and reflected in the earnings as well, that they have been increasing their product innovation, and also they are able to enhance their operating efficiencies as well as roll out a successful cost savings measure. So with that, we maintain our buy call with a target price of 98 cents. Next, I would like to bring you through Outsing, where we had a site visit on this Chinese dental clinic services business. So for those that are familiar with Q&M Dental, so let me just bring you through some of the background of Outsing instead. So for Outsing, right, it actually went with a partnership with Q&M Dental Singapore back in 2014. And if you can recall, it was being spun off and being listed on Catalyst last year in April. So what is Outsing doing? So Outsing is actually one of the leading providers for private dental services and dental equipment and supplies in Liaoning province, northern of China. So similar to what Q&M Dental Singapore is doing as well. So it has 3 business segments: the dental services, the dental equipment and supplies distributions, as well as the lab services. So I just put 2 pictures here of what we have seen. If you would like to see more pictures, you can actually download our reports. We have more detailed notes as well as pictures where you can see how their operations are being run in China. So just a side note for lab services. Lab services are the manufacturing for prosthesis in dental, something like your crown inlays. So after the site visit itself, we are actually quite positive on this company. So why is it so? We boil it down to 5 key main investment thesis for you. So first and foremost is that it plans to grow big in China, especially in the Liaoning province at the moment. So how is it going to grow big? It has a strategy to add 3 to 5 dental centers. So for dental centers, it includes both clinics as well as dental hospitals in China every year. So just to give you a context of what do I mean by dental hospital. So if you can imagine that our typical dental clinic in Singapore, usually you will see probably maximum about 6 chairs of 6 dental chairs in a bigger scale dental clinics. But if you compare it against the dental clinics in China, usually one floor itself may be housing 6 to even 12 dental chairs. And if you compare that against a dental hospital can be up to 4 floors. So imagine 12 times 4. So it's about 48 dental chairs in one single building itself. And we believe that Liaoning province is actually underserved at the moment. And Outsing is going to emphasize on pedodontics. So what is pedodontics? Pedodontics are pediatric dental services. So we believe that this market has a lot more potential to grow, especially that if you look at China's single child policy, where parents are more willing to spend on their child, as well as the increasing affluence in China. And if we come back to 2018 itself, its expansion plan is actually on track, where we have seen 1 new dental hospital that's being opened in Panjin City, as well as 1 new dental clinic in a shopping mall. Both of these are being opened in May this year. And they have recently announced a potential acquisition of Yuxing Dental Clinic as well. Next, we are also positive on its diversified portfolio, where just now I've showed that it has 3 business segments consisting both the downstream as well as the upstream. Thirdly, we are actually it's actually quite an eye-opener for how Alsing is able to grow its own new blood to fit into its expansion strategy. So what do I mean by this growing its own new blood? It actually has a collaboration with the Jingzhou Medical University, where it will groom or they will train a group of young dentists, and these young dentists, after graduation, they are actually recognized by the China University, and Alsing already has a ready platform for this group of young dentists to practice. It's also embracing technology, as you know that Alsing has, or QNM Singapore as well, they are actually having this CAD/CAM technology system, where you can actually complete your crown or even bridge inlays, bridge processes within one single trip. So you don't have to get a second visit just to have your crown ready on the first visit, and to have it inbuilt for the second visit. So this actually forms a competitive edge for the group, as the smaller players do not have such financial muscles to invest in all these machineries. It also has a very clean balance sheet. It has 0 debt and a net cash position of 95 million renminbi. So just to put you into a context of what this cash means. So typically, if Alsing, based on their historical transaction of acquiring a new clinic, right, it usually will cost about 20 million. So half will be financed via new shares issuance, and the other half via cash. So they will incur 10 million of cash payout per acquisition. So 95 million means that it can provide the enough funds for them to acquire 9 new clinics. So next, just to give you some of the picture of how these 3 or the expansion plans that's going to add into the top line. So do note that I've excluded FY18's assumption because the 3 or the 2 new hospital and clinics are being opened in May or mid of FY18, and the acquisition has yet to complete. So I fast forwarded into FY19 instead. And I took a very conservative approach where I do not take into account of if there's any potential new dental centers being opened in FY19E. So assuming that its existing business is going to grow by about 4% per year, and assuming that I'll just bring you through the second slide where there's a clearer assumptions being made. So assuming that the new Panjin Hospital, which is this slide, this slice here, the orange slice, that's going to contribute to about 70% of their FY17 top line, and as well as the 2 new clinics that's going to contribute about 4% to the top line. So this actually will flows down to the entire group being, the entire group's top line being at a very high 30-ish growth per annum in the next up 2 years. And if you look at the bottom line, We have also took a conservative approach where we took into account of the startup costs being incurred. Nonetheless, we also expect that it should be partially offset by the new clinics, where the new clinics will be able to break even sooner. The new hospital should be able to break even within the next 2 years, meaning by end of first half of FY20. So with that, with all these assumptions being taken into account, we believe that the PATMI should grow at about 20% per year in the next 2 years. And we've done a very quick and dirty valuations on this on housing, and we believe that with our base case valuation, it worth about 29 cents per share, and this is actually pegged against 35 times PE. And if you look at 35 times, we believe that the relatively high PE is justifiable, because given the exposure to a high growth dental market in China, and secondly, it has dental hospitals. So hence, we actually took into account of some of the hospitals listed in Singapore. And nonetheless, do note that we have already added 20% discount to the peers average. So with that, I'd like to pass on the presentation to Richard, who will talk about SATS.
Thank you, Lin Xin. Hello, this is Richard speaking. Okay, so as you can see, I'm going to talk about SATS. Okay, we've upgraded to accumulate from neutral. Higher target price also 5.58. Dividend per share, we are forecasting 18 cents, same as the FY18, which has just completed. And that will give you a 3.4% yield based on last Friday's close of 525. So first up, revenue-wise, is lower year-on-year for the full year by 0.3%. This is due to the deconsolidation of SATS Hong Kong since end of July 2017. This was a wholly owned subsidiary of SATS, and they sold 51% stake. So it has been deconsolidated to the associates line. And that contributed to the lower revenue. Had that not been deconsolidated, full year group revenue would have been higher by 1.5%. So what that means is that underlying still there has been demand for the business. At the EBIT level, you can see it's lower as well. This had some partial contribution from the effect of that deconsolidation of SATS Hong Kong, but main reason why operating profit had failed to outpace the lower revenue, I'll explain it in a bullet point below, but that's coming from Changi. Then for associates and JV, you can see that it grew 9.2% year-on-year from 65 to 71 this year, mainly from higher contribution of the gateway services and partially offset by lower food solutions. Reported PATMI was higher 1.4%, and if you exclude all the one-offs, underlying recurring PATMI is just marginally higher, 0.8% year-on-year to 236 million from 234 million last year. Now, first thing, dividend, we'll talk about dividend. So, final dividend proposed is 12 cents. That's higher than last year's 11 cents. So this is a demonstration of what the management has repeatedly articulated on their dividend policy is a sustainable and progressive dividend policy. So if you look at the 5-year historical full-year dividend since FY14 to the current completed FY18, you see it was started with 13 cents and then followed by 14 cents, 15 cents, 17 cents, and this year is 18 cents. So dividend has been increasing every year for the last 5 years. To give a flavor and to summarize the results, gateway services at the operating level and associate JV level benefited from higher cargo volumes and flights handled, but food solutions facing pricing pressure. So that is what overall has happened for SATS in the year in a nutshell. I'm going back to talk about the operating expenses. So there was some increase for the license fee that was due to the cessation of the rebates and incentives at Changi Airport since 1st of April 2017. So this actually is not new. It has been going on for the last few quarters already. Of course, with that higher operating expenses, there has been lower staff costs and premises costs from the deconsolidation of SATS Hong Kong. So that deconsolidation affected both our revenue and EBIT, bringing them both lower. Overall outlook is positive for SATS. They have been investing in new ventures and partnerships, and there's been inorganic growth at the associates and JV level. They're also growing their footprint across Asia and leveraging on technology to improve productivity as volumes increases. So I'll just talk a little bit on the two interesting JV that they have. First is the AirAsia one. So to update on that, if you recall, they have entered into a joint venture to do ground handling with AirAsia. The first phase is in Malaysia, so they are doing the ground handling for AirAsia in all the airports in East and West Malaysia that AirAsia operates out of. And currently AirAsia is the sole customer for this ground handling joint venture. So first stage of their integration is for SATS to help that joint venture to bring service level up, improve service level. And then in phase 2 of their integration, they will introduce technology, and so that they can they will introduce technology to improve efficiency and to get scale. So that's when they will start to try to acquire third-party customers, i.e. other airlines, to become a customer of the AirAsia's SATS ground handling company. The other interesting joint venture that the market is looking out for is their memorandum of agreement with Turkish Airlines to develop the largest in-flight kitchen in the world in the new Turkey Istanbul airport. So there's been some delay in that venture. One of the reasons for that is that they're still negotiating some terms of the currency issue, because the Turkish lira has been depreciating. So they're trying to structure an agreement such that they can be insulated from the currency effects in this venture. Okay, so now we'll move on to Minin, who will talk about banks.
So thanks, Richard. So now moving on to the Singapore Banking monthly update. So for the 2018 outlook, we are expecting that the flow-through rate from US interest rate hikes, it has really picked up in the recent months. So we can expect higher interest rates across the majority of the Singapore banks, and net interest margins will rise as well. So loans growth will also strengthen year on year in April across the majority of Singapore's business loans and consumer loans as well. So we can also expect broad-based loans growth and high single-digit loans growth from the banks. And oil and gas loan quality experienced no further deterioration, but we are expecting slower recovery as day rates are not increasing as fast as utilization rates have increased. And IFRS 9 took place in January 2018 this year, so we have seen that the bank's first quarter financial statements have already reflected this change. However, we need clearer disclosures if we want to make meaningful comparisons between the expected credit losses between the banks. So in this area, we will expect higher volatility in provisions. And lastly, we are in the face of uncertainty from geopolitical risk and trade wars, we expect that if most Singapore companies are export dependent, if their cash flows are hit from these issues, the credit quality of the banks will be impacted as well. So you can see in Singapore's FY 2017, our export to GDP is 115%, which is very high. So any impact from global trade wars or geopolitical risk will definitely affect Singapore companies. So Singapore's domestic loans growth grew 5.7% year on year in April, and this is an acceleration from first quarter 18 growth of 4.8%. And it actually strengthened in April, and this is mainly driven by business loans, which expanded 6.1% year on year, as you can see from the dark blue line, and the red line is the consumer loans, dark blue line is the business loans. So business loans is mainly driven by the loans to financial institution and also the building and construction industry. So the main thing is that the building and construction industry actually recovered in April with a 0.5% year-on-year growth as compared to a negative growth in the past few months. And consumer loans expanded 5.1% year-on-year, which is not bad because they sustained the strong momentum since November. And mortgage loans expanded 4.7% year-on-year, and this is a 3-year high in Singapore. And car loans actually reached a 5-year high at 7.8% year-on-year. In Hong Kong, loans growth grew 17.1% year-on-year, and this was actually the fastest loans growth in 6 months. And this loans growth was driven by Hong Kong dollar loans, which expanded by 25%. And the reason why this loans growth expanded by so much is because in April, it was boosted by IPO financing. And if we were to exclude IPO financing, Hong Kong dollars loans rose 19%, which is not bad as well. So according to JLL, Hong Kong's residential volume and value showed recovery after a slight weakness in January. So we can see that residential sales volume increased by 55.9% and residential sales value increased by 59.3%. So this increase is mainly driven by demand from first-time home buyers, coupled with the developers' ability to drive up prices in the secondary market where supply is limited. So what happened is that because of the tax law in Hong Kong, it makes it difficult for existing home buyers to upgrade their houses. So this will result in the secondary market supply being limited for the first-time home buyers to purchase their first homes. And as the interest US rate hikes increases, Hong Kong HIBOR also showed a similar trend of increasing. So even despite this increase in HIBOR and loan rates, the first-time home buyers are still not deterred in obtaining loans from the Hong Kong banks to purchase their first homes. So moving on to SIBOR and SOR, it actually continues on a gradual upward trend where 3 months SIBOR reached its highest level in 10 years and 3 months SOR reached its highest in 2 years. So as you can see from the graph, the blue and light blue lines are the SIBOR and SOR, and the red line is the bank savings deposit rate. So over the years, it remained relatively inelastic and stable, and this is the cost that the banks incur when they loan out money, and this gap is the NIM's expansion that the banks want. So as the US interest rate Fed hikes continue to increase more, and we see the expansion being more prominent in the future, in the next few quarters. So we expect the Singapore Bank's net interest margins to be on a gradual upward trend, given that there will be 3 or more Fed rate hikes in 2018. So NIM's expansion is the main share price catalyst for the next few quarters for the 3 Singapore banks. And despite this 40 basis points increase in SIBOR rates, mortgage loans actually remain relatively resilient at 4.7 year-on-year. So we do not expect the new mortgage loans to be adversely affected by the gradual increase in SIBOR and loan rates. So lastly, moving on to the offshore oil and gas sector, the operating conditions are improving but recovery is weak. Utilization rate hover around 60%. For the past few months, and average day rate is still on a decline. Oil and gas non-performing loans are still quite strained right now, and we expect that recovery is weak, even though we do not see new non-performing loans forming. So oil prices also rose, but we do not see charter fees increasing, even though the volume of business increased. And this is mainly because utilization rates are not high enough for the offshore contractors to actually have much pricing power in the day rates. So this sector is actually plagued by structural overcapacity, which makes it unlikely to see a recovery in profitability in the short term. So we maintain Singapore banking sector at accumulate, and this is mainly because of loans growth continues to remain healthy. Banks are guiding high single-digit loans growth in 2018, and this is supported by the vibrant loans growth in Hong Kong as well. And the continuing rise in SIBOR and SOR will keep our net interest margins elevated, but volatility in the capital market may place some downward pressure on wealth management business, because historically wealth management business is usually correlated to how well the market is doing. So the recent volatility might actually affect the wealth management business of the banks. So all in all, banks are benefiting from both expanding loan volume and margins this year. And these are the target prices. Okay, so now I'll pass on to Jeremy for the recession tracker.
Thanks, Mining. Good morning, everyone. Jeremy speaking here. So I will just briefly give you guys an update on the US recession tracker for the month of May, what's been happening. So as you can see over here, clearly what we see, at least since January until end of May, is definitely we are seeing the back to risk on mode that has been shown in the equity market, more so within the small cap stocks. So I will show you in a while what I mean by that. And let's just dive into the recession tracker on a monthly perspective, what we see. So here's the snapshot of the recession tracker. So for those that haven't been following this monthly recession tracker, basically it's a list of indicators. As of May, we have actually included two more indicators here at the bottom of the table. Core capital goods new orders, as well as industrial production year-on-year change. So these are the two new additions to the recession tracker. And all in right now, we have a total of 17 indicators that we kind of follow to give us a good sensing when the next market top will happen. Again, the reason why we are so concerned about the market top is because we are right now in the third, more so second longest economic expansion in history since 1930s. So right now, the economic expansion since the global financial crisis, right now we are in a range of around 107 months of economic growth. And this is the second longest economic expansion in history, which is why we are kind of concerned that the market is kind of ripe for a turnaround and heading into the recession next, as this is the business cycle that kind of follows moving from an economic expansion to a recession. And definitely right now we are in a late stage economic cycle, and henceforth we are kind of watching this recession tracker very closely to kind of warn investors when the top might be in. So all in right now, based off the recession tracker, we are still pretty bullish on the equity market in the near term, probably another 8 more months or so before we see some major crack signs. As of now, you can see over here, there is only one indicator that is flashing red, which is the VIX index. The signal got triggered back in February, where we saw the VIX index spike up more than 100% in a single day, and above our threshold of 27.7 in early part of February. But since then, after hitting a high of 50 in February, we have seen the VIX index subsiding off its high and coming back below the 20 range. And more so for the past 5 weeks, we have seen the VIX index trading back below 15, which is a pretty good sign that money is flowing back into the risk asset again. So all in right now, in terms of recession tracker, you can see the rest of the 16 indicators remain pretty much well in check, and all still signal to us that the bullish outlook for the equity market kind of remains intact for at least the near term, for 8 more months out. So crack signs that we see probably will only start somewhere in 2019, where we see monetary policy starts to come back and haunt us in terms of bringing back liquidity, sucking the money out from the economy. 2019 will be the era where we see full force coming in terms of liquidity getting sucked out from the market. Federal Reserve right now is kind of shrinking its balance sheet, at the same time increasing its interest rate. ECB will be the next one to kind of announce to us when the monetary tightening phase will happen. So as of latest ECB meeting, we are expecting the ECB to kind of taper their QE program from 30 billion to 15 billion or 10 billion starting in September. And then starting next year is when they will only reinvest whatever that's maturing. So all in 2019 will be an interesting period in terms of the central bank policy that's been coming out. And that should provide some headwind for the equity market. But all in right now, we are still expecting, at least for 2018, for the equity bull market to sustain moving forward. And I will illustrate a few highlights from the recession tracker for the following slides. But again, another highlight that happened last Friday was the unemployment rate. So unemployment rate continued to improve. We edged down 0.1% from 3.9% to 3.8% for the month of May. All in again, multi-year low for unemployment rate perspective, still showing strong growth. So unemployment rate continued to improve. Threshold to watch is 4.2%. As of now, it's still a far cry away from that level. And again, signaling to us that the equity market has further room to go to the upside. So let's just dive straight into some of the highlights for the recession tracker for the month of May. So here's the VIX index that I've just talked about. This is the early spike high in February where it hit a high of 50, which then triggered our threshold of 27.7. But since then, you can see VIX index came off its high. And more so, this highlighted area here is where we saw the VIX index trading pretty calmly back below the 15 range for the past 5 weeks. So all in, as long as the VIX index continue to trade relatively below the 20-25 range, we believe that should kind of usher in the bull back into the equity market. And we do have that outlook for the VIX index to continue to stay below its immediate ceiling of 20 to 25 range, mainly due to the net futures positioning that's been happening within the VIX futures. So the bottom panel over here shows you the VIX futures net non-commercial position, basically the speculators positioning within the VIX futures. So you can see historically, whenever the VIX futures positioning hit an extreme record high, so our study shows that that record high is around 15,000 contracts. When it actually exceeds that range, long squeeze is not too far away. And what I mean by that is the speculators tend to get it wrong when they are all on one side of the game. So as you can see over here, whenever they are extremely long the VIX futures, for this instance, these 3 points over here marked by the vertical lines are the point where we saw the VIX long squeeze happen. So when the long squeeze happened, the long speculators are forced to unwind their position, and hence they are forced to sell their position, and you can see the resulting impact on the VIX index. When long squeeze happens, we saw the VIX index tumbling 27%, 44%, as well as 36% during these past 3 occasions. And definitely the most recent example in April is almost a mirror image of these past 3 examples, as the net non-com futures position hit an extreme high of 92,000 contracts, which is unprecedented in a way. So all in with that long squeeze that happened back in April, you can see the VIX index have tumbled back down to the range of 15, more so even 13 low that we saw somewhere in May. So all in, we believe that the VIX complex right now is still going through this period of long squeeze, even though the net non-com position right now are in negative, which means net-wise speculators are right now short. But you can see in terms of relativity-wise, the VIX futures positioning is still relatively on the high side of things. So we expect this long squeeze to continue, and that should continue to cap the VIX index movement below the 20 and 25 range, and that should spark further risk-on behavior in the equity market. For the VIX futures to signal sustained move to the upside, I think the VIX net speculative position should actually head down to a more low range of somewhere around negative 75,000 contract first before we see that sustained move higher. All in right now, immediate moves still suggest to us further upside within the equity market. Moving on to TED spread. TED spread basically, for those that haven't been following, basically measures the 3-month LIBOR to the 3-month Treasury yield, the spread between the 2 asset class. And basically, for those that don't really know what it means, a rising TED spread shows the stress within the interbank market. And on the flip side, falling TED spread shows all is well within the interbank level. So what we saw, at least in April, we highlighted some early crack signs when the TED spread starts to spike above this range over here, the 36 basis point. And you can see since February, once we broke above this range, TED spread just went crazy and hit a high of 63 basis point. Since hitting the April high of 63 basis point, we have seen the TED spread subsiding off its high. And also at the end of April, it fell to a low of 56 basis point, and you can see this falling trend continue for the month of May. So all in terms of TED spread wise, it's signaling to us that the market is moving back into a more normal range, and it should bode well for the equity market moving forward. And just to highlight again, the key threshold for the TED spread is actually a 1% level. So even with the recent spike in April where it hit a high of 63 basis point, it's still a far cry away from the 1% threshold. All in suggests to us that it could still easily take the market a few more months of crazy movement to the upside for the TED spread before it signals the end of the equity bull market. which is why we are still bullish in the equity market at least 6 to 8 more months out. Moving on to the 210 spread. Again, 210 spread, basically, for those that haven't been following, basically is a proxy for the yield curve. It shows us the spread between the 10-year Treasury yield to the 2-year Treasury yield. And more recently, since April, we have seen the 210 spread actually kind of traded relatively calmly between the 54 basis point range high as well as the 41 basis point range low. So all in right now, it still suggests to us in the immediate trend, all remains well until the long-term trend of the 210 spread continues to cause further flattening within the 210 spread. So right now, we are still expecting the 210 spread to kind of flatten out as long as the Fed continues with its rate hike cycle. Right now, the Fed Fund Futures is predicting 100% odds of Fed rate hike in the FOMC meeting in June. So that will bring the Fed Funds rate to 2%, and probably another one in September, which will then leave the Fed Funds rate to 2.25%. So all in, as long as the Fed continues with the rate hike cycle, we believe the 210 spread will continue to flatten, purely because that the 2-year Treasury yield, which is the shorter end of the yield curve, tends to react more sensitively to the Fed funds rate hike as opposed to the 10-year Treasury yield, which is the longer end of the yield curve. So all in, as long as the Fed continues with the rate hike cycle, this flattening trend should continue within the 210 spread, and it's just a eventuality before the 210 spread inverts and hits below zero. And it's usually that inversion of the yield curve that signals to us the recession is not too far away. So our base case study shows that for the flattening trend to continue, it could still easily require the market another 33 more weeks of further flattening before the 210 spread inverts. So again, 33 more weeks should more or less give us ample time for the equity market to rise up within the next 6 to 8 more months before we see the bearish signal within the 210 spread signals kind of engages itself. So all in that term, again, based off 210 spread, we are still bullish in the equity market until the inversion of the 210 spread happens. Some negative data point from the economic data perspective. Here is Bloomberg Consumer Comfort Index, basically measuring consumer sentiment. So all in the other two metrics that we follow, the UMich Consumer Sentiment as well as the CB Consumer Confidence Index, both are also kind of waning off from its respective multi-decade high. And this trend is more prominent in the Bloomberg Consumer Comfort. You can see over here the highlighted area. This is being measured on a weekly perspective, so it gives us a more live, up-to-date feel of what the consumers are feeling. So you can see since hitting a high of 58.1, which is the highest level since 2001, we have seen 4 consecutive months of kind of a disappointment in the Consumer Comfort Index, falling from 58.1 to the current level of 55.2. So we continue to watch this trend. Something alarming here, which is these 4 consecutive weeks of disappointment. But all in, we need the further confirmation from the Conference Board Consumer Confidence as well as the UMich Consumer Sentiment Index to confirm that mean reversion pattern as well of its multi-year high. And ultimately, the key trigger point for the start of the bearish market will be for the Consumer Sentiment Index to actually break below its multi-year uptrend line that I've drawn over here, which is still a far cry away, somewhere below 50. So all in, continue to watch this space. For that to develop, probably it could still easily take us 6 to 8 more months of further downside before it triggers its bearish signal. Same thing over here in the manufacturing side. So the manufacturing PMI measures sentiment of manufacturers, and same thing over here, we are seeing some weakness within the PMI numbers. So since hitting a high of 60.8 somewhere in, I think, February, we have kind of came off the high of 60.8 for 2 consecutive months. And more importantly is how this ISM manufacturing PMI tends to kind of head into a mean reversion whenever it's near its upper extreme end of things. So for ISM manufacturing PMI, we noted that the extreme high is somewhere around 58. And as you can see over here, whenever the ISM PMI kind of hits into the extreme boundary of things, when it's above 58, we see mean reversion happening during this period over here. Same mean reversion happening over here once it exceeds 58, as well as this whole period over here. And right now, definitely since 2018, after breaching 58, the upper extreme boundary that signals euphoria, we have seen the ISM manufacturing PMI coming off its high of 60.8. And this past 2 months of consecutive disappointment might be the start of this mean reversion trend that I just talked about. So in terms of watching the mean reversion, more importantly is when the ISM manufacturing PMI dips below zero, the expansion and contractionary level, for it to signal the end of the equity bull market, marked by the vertical lines over here in the chart. The ISM manufacturing PMI needs to at least contract for 2 consecutive months, which means falls below the 50 line for 2 consecutive months before the confirmation and the end of the bull market is shown. So you can see over here, the .com high was more or less being confirmed after the PMI falls below the contractionary level for 2 consecutive months. And you can see the resulting impact is a 45% sell-off during this period, as well as a GFC sell-off that was exacerbated after we got 2 months of contraction, which then follows a 50% sell-off over here. So all in right now, even if the mean reversion really happens and in this trend kind of continue to the downside, we need the ISM manufacturing PMI to actually contract for 2 consecutive months first before we get the full confirmation that the top in the equity market is here. So all in, it could still easily require us a few more months, 6 to 8 more months of further weakness within this PMI number to confirm the bearish signal. And hence, we are still kind of bullish in the near term for the equity market. And right now, we just dive into the 2 new indicators that we added to the recession tracker. So both of them are economic-based data. First one being capital goods new orders, non-defense excluding aircraft and parts. Basically, you can just think of this as core capital goods new orders. And what it shows is it measures the change of new purchase orders placed with manufacturers. And some of the purchases include construction machinery, electronic computers, medical materials, heavy-duty trucks, as well as office furniture. And just to give you a highlight, how we actually view this is a rising purchase order signals growing economy as companies spend more on expansion. So I illustrate in charts in the following slides how we actually use this indicator. And the second indicator that we included is industrial production year-on-year change, which basically measures the output of industrial establishment in mining, quarrying, manufacturing, as well as public utilities. And this production is based on the volume of output. And a rising industrial production signals a growing economy as output increases in anticipation of growing demand. So all in, these 2 indicators can be viewed in a similar fashion, and they trigger at almost a similar time point in time for calling for the end of the equity market. So over here, you see the capital goods new orders, non-defense aircraft and parts at the bottom panel, and the top panel is the S&P 500 index. And the key threshold over here to watch is the 0 line, which basically marks expansion or contraction. And you can see over here, the vertical line marks the point where we saw contraction. And at the same time, once we see the capital goods new order starts contracting on an annual basis, you can see it confirmed the end of the dot-com bubble peak as well as the end of the subprime housing bubble peak. So both periods over here, I'll just illustrate what I mean. So prior to 2000, you can see the growth in the core capital goods new orders are growing pretty strongly on an annual basis. Actually hit a high of 15.4% at one point year 2000. And you can see once the trend starts to kind of head down, and to a point whereby once it starts contracting, this point over here in December of year 2000 was when we get a confirmation that the dot-com peak was more or less in, and the resulting impact was a 41% sell-off in the S&P 500 index. And same thing over here, prior to the housing boom market high, housing boom period, we saw the core capital goods growth number on an annual basis grew to a high of 12.9%. On average, it was trading at around 8%, 8% annual growth during this whole period. But subsequently, when the trend reverses and when the core capital goods starts contracting on an annual basis over here somewhere in August, September of 2007, you can see it marked the end of the GFC high, followed by a 56% sell-off in the equity market. So all in right now, we are still seeing pretty strong growth within the core capital goods new order side of things. Recent high, we saw growth growing at 12.9% on an annual basis. And since then, we have come off that high, but nonetheless, we are still growing at a decent pace of 7.7% on an annual basis. So all in, until the point where we see the core capital goods falling below the 0 line and head into a contraction, we remain bullish for the equity market. And for that to play out, it could easily still take us 6 to 8 more months of further weakness before that happens. And probably I'll just highlight the yellow box over here, which is the abnormality in terms of these capital goods new orders failing to kind of usher in the end of the equity bull market during the 2012 to 2016 period. So there is a pretty strong anomaly here where the weakness in this data didn't really signal the end of the equity bull market. And the main reason for that is because there was unprecedented easy monetary policy that's been happening worldwide, more so within the Federal Reserve in the US, where we saw unconventional monetary policies such as quantitative easing taking place. And at the same time, we are seeing zero interest rate policy that has been implemented across the globe. So all in is with that easy monetary policy that's being kind of implemented to the world, and with that excess money supply that's been flying back into the market that is kind of propping the market up since 2012 to 2016, which is why the data from these core capital goods failed to kind of provide a reliable signal. But right now, since 2015, we enter a new era where quantitative easing has already turned into quantitative tightening, where we are kind of sucking money up from the money economy. And then at the same time, we are no longer in a zero interest rate policy environment. we are right now definitely moving in a period where we are facing a rate hike cycle. So December 2015 was when we raised our Fed funds rate from 0.25% to 0.5%. And right now, the Fed funds rate is at 1.5%. So all in, we are seeing a reversal of this QE and ZIRP. And the next time where these core capital goods new order starts plunging back below the zero contractionary line, we should more or less see a more representative move in terms of the equity markets, kind of confirming that weakness as well, like the prior two example during our GFC as well as .com period. For industrial production, you can use the same analysis from the previous slide that I've just shown. Same thing over here, the key threshold to watch is the 0% line. And more so whenever industrial production year on year kind of a fall into contraction, you can see I've marked up the vertical line to show you the point where the expansion phase goes into a contraction phase. What happens is it confirms the end of the equity bull market. So during a .com period, we saw a 41% sell-off after we saw the contraction in the industrial production year-on-year growth, followed by same thing over here, your GFC with a 49% sell-off when the industrial production year-on-year kind of faded off its 3.29% growth into a period of contraction. So right now, industrial production is still growing pretty steadily. Since 2016, it has been growing on a pretty strong pace, and right now it's growing at a 3.5% annual growth rate. So all in, until industrial production kind of continue to contract and hits below zero, we remain bullish on the equity market in the near term. And again, like I mentioned, it could still easily take the market another 6 to 8 more months of further weakness before we dive back below the contractionary line. And same thing over here, this yellow highlighted area is to mark up the abnormally point where the contraction in the industrial production failed to usher in the top. Instead, you can see industrial production year on year actually do provide a better signaling in terms of the market kind of heading into weakness. Somewhere in 2015, I think it's in January or Feb, where we saw this industrial production heading into contraction. You can see what happened for the equity market. The S&P 500 index actually more or less formed an immediate near-term top and kind of stayed slightly ranging for the whole of the 2015 to 2016 period until it kind of rose back above its zero line. So in a way, it provided a inaccurate signal, but it does kind of cause some headwinds to the equity market, because during this period, we saw the equity market kind of head into a 15% sell-off during this whole period over here. So all in again, like I mentioned, with the end of QE and ZIRP, and right now heading in a period of quantitative tightening as well as a rate hike cycle, the next time the industrial production year-on-year growth rate falls below the zero line and heads into contraction, we believe it will continue to become a reliable signal for the end of the equity bull market, like this 2008 example as well as this 2001 example. And last but not least, for investors, I think it's easier for you all to kind of lump these three indicators together. So for core capital goods, new orders, for industrial production, as well as for retail sales, you can lump these three indicators as like one big group, because they kind of mimic the same way in terms of signaling the end of the equity bull market. So for the previous two examples, the key threshold to watch was 0%. Once we get the contraction below 0%, that was the start of the confirmation on the equity bull market. And for retail sales, instead of seeing the zero line, our study shows that the level, the key critical level, is actually 1.6%. So all in, as long as the first two indicators fall below 0% and the retail sales number fall below 1.6%, I think more or less once we get the three confirmation from that three indicators, we will have more conviction in terms of calling for the end of the equity bull market. But as of now, you can see the three indicators are still going at a pretty strong growth rate. So even for retail sales, we are still growing at 4.6%. and still far quite away from its 1.6% key threshold. Or in the near term, we are still seeing sustained growth within the equity market, and on the economic-based data, wide perspective from a recession tracker, we are still seeing strong growth within the economic data. So in the near term, we are still pretty bullish on the equity market. And just looking at in terms of near-term price action, something interesting in the month of May, small cap stocks are definitely outperforming your big boy stocks, which is your Dow, your Nasdaq, as well as S&P 500 index. So here's the Russell 2000 index. So just to illustrate what I mean, you can see since hitting a record high back in January, a high of 1,615 points, it was being followed by a 11% sell-off, mainly caused by the VIX index explosion incident. But since then, after hitting a low in February, you can see a strong rebound in the small cap stocks, rebounding a sharp 13%. And it's more recently in May that we kind of broke above its prior record high of 1,615 points. So all in right now, definitely the small cap stocks are kind of being loved more than the big boys. And it's with that money flowing back into the risky asset class, we are anticipating that the laggard, which is your big boys, to kind of follow suit. So we expect the S&P 500 index, the Dow Jones Industrial Average, as well as the Nasdaq 100 to retest its January high as well. And just to illustrate the near-term price action that we are seeing, some notable price action, you can see this is the S&P 500 index on the daily time frame. And just to show you some interesting price action is this triple bottom rejection of the green line, which is a 200-day moving average. So it's with this triple bottom rejection since February that we think that the uptrend is ready to re-engage itself. And just to keep in mind, the amount of energy that's being stocked up since January over here, with the amount of inaction that's been going on, we believe with this recent bullish breakout of this downtrend line, somewhere around in May, this bullish breakout could more or less stir and spur the next wave higher for the S&P 500 index to kind of retest this immediate resistance at 2,800 points, followed by the January high of 2,878 points. All in terms of near-term trend, it has also recently just kind of shifted back up with the red line crossing above this blue line over here, which is the 20-day moving average crossing above the 60-day moving average. And all in right now, we are seeing immediate trend turning up, with the long-term trend kind of still signaling that the bullish uptrend is still more or less intact. We are expecting the S&P 500 index to retest its January record high of 2,878 in the near term. And same thing for the Dow Jones Industrial Average, pretty similar picture. Nice triple bottom rejection of the 200-day moving average, as well as the bullish breakout above this downtrend line. Same thing, we are expecting the Dow to first retest this 25,774 points immediate resistance, followed by its prior record high of 26,684 points. And last but not least, on the Nasdaq, which is the strongest amongst the three big boys, we expect the Nasdaq 100 to retest its prior record high that was set in March at 7,200 points, followed by 7,300 points. I haven't updated this chart, so this chart was as of last Thursday. But last Friday, we actually had a pretty nice breakout above this 7,000 big round number psychological area. And you can see since that breakout, futures market right now is up around 0.3%. So in terms of bullish momentum, we are definitely seeing the Nasdaq 100 leading the pack here for the big boy indexes itself. So it's with that last Friday's bullish breakout above this range, more so the 7,000 range high, we are expecting this bullish momentum to sustain for the Nasdaq to retest this 7,200 points, followed by 7,300 points in the near term. And hence, in summary, for the recession tracker overall, it kind of continues to advise us to stay on a risk-on approach moving forward, despite the ongoing political scare in Italy. And until the economic data turns bad and triggers the respective threshold, we remain bullish on the equity market for the Dow, the S&P, and the Nasdaq to retest its respective record high that was set back in January and March. And more importantly, is with that current bullish price action of the 200-day moving average in the S&P 500 and the Dow, as well as the Nasdaq 100, we see a likely move back up for the three main indices to retest its respective record highs. So here are some of the ETF to capitalize on the bullish move within the US market, as well as some CFD to capitalize on the speculative move to the upside. And yeah, with that, we've come to the end of today's webinar. We'll right now pause for Q&A if there is any questions. Thank you. There's a question asking where do we record or upload our recordings for our past webinars. So everything can be found on this website over here, stocksbnb.com. And you just scroll down to this part over here where you will see the latest webinar as well as our past webinar. So everything is being parked under this page for our weekly updates on the market. So here is where you can find the past few episodes of our webinar. Okay, since there are no more questions, we'll end today's webinar here. Thank you for tuning in and hope to see you guys again next week.